Hey folks, welcome to Pro Trader Strategies. My name's Eric Wilkinson and this is Spotting the Trade. Well, usually what I'm going to do throughout these videos is talk about the economic data, see how that's impacting the overall markets, and then talk about trades that we've spotted for opportunities that we can take advantage of. So if you are watching this live and you would like to watch these videos, make sure you go down there next to the subscribe button and there's a little bell. You got to click on that bell to get the notification that we're going live. So make sure you guys have that bell lit up, all right? And throughout this video, if you have anything that you really have that light bulb moment, make sure you smash that like button for me because that will share that information with somebody else out there just like you, all right? And make sure you're commenting over there at the side if you want me to cover any stock or any type of equity, ETF, bonds even. Let's talk about that over there in the comment section. And hey, we've been doing interviews lately. If you want me to interview somebody, throw that over there. Give us some ideas. We'll reach out to those folks. All right. So without further ado, let's get on with the economic data. Something we didn't really cover very much in the past day or so was the inflationary numbers. And we got our CPI, which is Consumer Price Index, folks. And that is one of the leading indicators of whether or not the inflationary pressures are being passed down to the consumer. Now, remember, the consumer can be also a service sector type of business where they are buying still different types of products. So those guys will be added into the CPI, but CPI coming in at 0.9%, expected to be 0.6%. Folks, last time we really saw these kind of levels in inflationary numbers was back in the 70s and 80s when interest rates were around 8%. Now, why aren't we getting that type of interest rate spike going on right now with these types of inflationary gauges? Well, we've got some different levers and pulleys going on here right now. We're struggling to get this economy going and we're seeing inflation. Usually what happens is, and we would be okay with it, is if the economy was really firing on all cylinders and we then saw that inflation, well, that would not be as bad as just having inflation with a stagnant economy. And that's the type of situation we're getting into right now here. All right, so and then if you strip out food and energy, it comes in at 0.6%, still really elevated levels here for the core CPI. And then crude oil inventories, we also saw a bit of a drawdown, not quite as much of a build as what was expected. So that was somewhat celebrated in the overall markets as there's demand there, but it's really not showing up in the futures here, as we'll see. I'll share this. We can see here in crude oil after that economic data point, we started seeing crude oil start to fall again yesterday. So some weakness here in crude oil. Now, I was expecting us to see more weakness in crude oil rather than the strength and a push back towards 90. I was expecting more of a push back towards 70 as we're seeing this manufacturing sector really not do as well as what was originally predicted. And that showed up in the Great Britain economic data points overnight. And that was in the industrial production, manufacturing sector, and things related to that type of economy. And we saw all of those numbers pull back a little bit here, folks. Manufacturing, industrial production, all of those numbers really pretty weak for Great Britain there. That's also going to act as weakness for crude oil, because when the manufacturing sector starts slowing down, that's when the weakness in crude oil starts showing up because of the lack of demand for the manufacturing sector. We talk about that all the time, folks. All right. Also, bonds. We were talking about this yesterday. In the past couple of days, I was expecting us to see this 160 handle hold on. Now, yesterday, we did break below this Fibonacci, albeit for just a moment. The settlement is the key. We got a settlement really just above that area. We're right above that area right now. I do expect us to kind of park ourselves right here in the mid 160s. All right. Now, yes, you guys are probably saying there's inflation around the corner. Well, it seems that we are waiting on this inflation because of the lack of economic boom. We want to see that economic boom with the inflation, and they can't really start raising interest rate because interest rates, when you start to raise them, slow down or cause the economy to slow a little bit. Well, they don't want that right now. There's two mandates for raising interest rates, and that's inflation and slowing down the economy. Get us to become savers rather than spenders, because when you're spenders, that drives inflation. Well, They're in a tough bind right now, folks. And I think that we're going to see interest rates hold on to here. Now, what was happening here in gold? Along the lines of what we've been talking about. It's an inflationary gauge. And if it's only transitory, it shouldn't stay higher. But now that we're starting to see some of these higher inflationary numbers getting passed down to the consumer, that means that it is not as transitory as what originally was talked about by the Fed. So we're seeing gold really start to make those moves higher back towards those 1900 handles that I've been talking about. Now, we've also been seeing crypto make some big moves to the upside. I've been talking about Ether making more incremental moves higher. Well, I was talking in dollar terms. Yes, it has beat Bitcoin in percentage terms, because when we were talking about it was just below 2,000 for Ether, and now it's trading above 4,000 and almost 5,000. So it has had that move higher, but I was expecting that move to be closer to the 20,000 in Ether, just due to the demand in all of the NFTs. I thought that this was going to be, Ether was going to be the one that actually survived or gained incrementally over Bitcoin. But that entire space is driving higher, and that is really due to the fact of what is happening globally with current global currencies. And that's how the governments of those currencies are influencing the price, okay? And if you are in crypto, you don't like that kind of manipulation happening. All right, we're seeing NASDAQ start to make a move a little bit here today to the upside. I would say risk right now for equities is more negative than positive. Again, I'm back on that camp. Why? Because we can't combat inflation right now, and the market is trying to drive higher because they aren't going to raise interest rates. Well, there's a bit of a disconnect, and I talked about this in the past, that we would probably see the equities make those moves higher if the expectations of interest rates moving higher started waning, and that has. We've seen the bonds move higher, and remember, when the bonds move higher, we see interest rates go lower. It's just a teeter-totter effect, and that's what we're seeing in the markets right now, and that gave a little bit of a boost to the upside in equities here. So I got a new pin here. Let's try it out just to talk about the teeter-totter effect in equities. And I think I got a black pin on here. Let's just talk about this right here. So if we talk about the teeter-totter effect, and we're talking about price and percent, right? So if we see price go down or bonds go down, that means interest rates are going higher, folks. And that's kind of the situation we're getting in right now. If bonds, now what we're seeing is price going higher, right? In the bonds are moving from 150s to the 160s. Well, that means that interest rates are now going lower. All right. So that's the levers and pulleys of those markets. Now the market wants to see those go higher, and that's what we're seeing right now. It is, matter of fact, E-mini S&Ps, Dow Jones. I was expecting Dow Jones to hold on a little bit more than what we're seeing with the NASDAQ. But again, yesterday with the E-mini S&Ps, I talked about keeping your eye on this trend channel, and we broke below it again. I didn't expect it to hold, and I talked about that in these spotting the trades, that the risk was to the downside. I would not try to play this on a bounce off of this trend channel right now. I thought it was going to test it and break through. I am still expecting us to start losing a little bit of momentum, come down and test the last highs there, which is going to line up with 4,550 is my line in the sand for the E-mini S&Ps. You can see we're just above that line right now. But again, I'm expecting more weakness here in equities. Now, I wanted to talk about RIVN a little bit here, because it IPO'd, and it is an electric automobile truck manufacturer. I believe they're actually out at the West Coast here. I think it's actually Arizona, but they could be over in California at this point. But something to note with this, when they IPO'd, they increased in value, obviously off of 95 all the way up to 120, as we're seeing here. Well, one thing to note with this company, it just started making automobiles. I think Google or Amazon or somebody ordered 100,000 of them. Well, again, just like Tesla, with that move higher that we saw with the rental car companies getting the Teslas. Well, we're seeing very similar situation here with RIVN. And the fact of the matter is it is valued as of yesterday's close more than what Ford is worth. Yes, Ford. All right. Today, off of the pre-market indications, we'll go to the pre-market here just to give you a little bit of an idea here. Pre-market indications settlement yesterday, as you can see, was quite a bit lower than where we are right now. We're trading right now, looks like around 108-ish. So we're almost 10% higher here in RIVN. Well, what does that equate to? Well, it's worth now more than GM. All right. Not GM and Ford combined. That's like Tesla. It's worth more than all the other automobile makers. But RIVN, if they produced as many cars as Ford and GM, then you might be able to think, hey, that might be worth it. But there has to be something else here that folks are investing in with these electric car companies that's more than just an automobile. And nobody really knows what that is. It's just the expectation that they will be able to become a power plant or something like that for electricity. That's quite a ways down the road, folks. And I don't know if we should be pricing that in at this point in time, to be quite honest. The infrastructure that we have around our electricity grid cannot handle. Basically, if you look at any given neighborhood, it can't really handle on one of those streets more than 3 of these electric car units. Really, what it does is it causes a real drag on the entire system. So if everybody in your neighborhood had a car, you would not have electricity in your house. Probably you would be blowing it out. All right. So anyway, RIVN making those moves higher. I just wanted to talk about them because of the valuation for the most part. And I'm looking at a trade for TLT here. We're going to be looking at the strangle, and I'm going to be trying to put on a trade around this because I think that TLT is going to pull back a little bit. And we are going to be talking about a couple of other things with the bonds, interest rates rising. If interest rates start rising, that means that the portfolio value goes down, right? So again, inversely related in a sense. Let's see if I can erase all this here. What we were talking about with interest rates, again, is that if we start to see the bonds, the price of the bonds goes down and interest rates go up. Or you can think about it this way. If interest rates start going up, well, we can then say bond prices are going down. And if bond prices start going down, think about that, how that affects your portfolio value. Interest rates start going up, those bond portfolio values go down. So in your portfolio, just like stock price going down, you own that asset at a higher price. So those values will go down. Yes, you will get par value if you hold on to it to the end of the day, but the average person holds their bonds for 7 years. That's it. So in the course of the next 7 years, we could very well expect to see interest rates rising, especially layered on the fact that we have higher inflation. That's going to lead down the road to higher interest rates. Higher interest rates, lower bonds, your bond portfolio is going to get decimated. I'm going to talk about the levers and pulleys around that next week in a couple of videos that I'll share with you and you guys can participate in some of these live events as well. And I'll share all that information as we go forward. But if you, so far, if this was a light bulb moment, folks, where we're looking at the interest rates and all of the levers and pulleys around that, make sure you guys hit that like button, share that information with somebody else. And if you're catching on late here because of the timing issue, make sure you're subscribing and hitting the bell right next to that, because that will give you access immediately. It'll give you a heads up that I'm popping in here. And if you guys want to comment, I'm doing interviews right now. Please throw some names down there. Give us some names to reach out to folks, and we'll try and get them interviewed here at Pro Trader Strategies. So anyway, that's what we've got with that. And I want to try and figure out, do I always have to race maybe with this new product? Anyway, so we've got that all gone, and let's drop it like it's hot. And then this is the other one that I'm looking at. We're getting a bit of a move here higher right now, pre-market. But I am looking at doing the strangle around Kroger as well. We've got high implied volatility, as you can see here. And we also are seeing the market nailed down right in and around this point of control. So I'm looking at these two Fibonacci's, third Fibonacci lining up with the point of control. I don't think that'll act as a support and resistance because there's too much money being transacted at that level that it's just going to kind of peter out there or die around that level because of the point of control. That's where the time and volume's been spent, folks. That's where the overall market perceives value for Kellogg. And with that higher volatility, we can see we got a little bump here after their earnings. Now, earnings weren't too bad, right? I mean, in line with expectations, but they got that move back up to the point of control where their value is perceived. Now we can see that after their earnings, they do have a tendency to sometimes get a bump and a drop afterwards. Well, I feel like that's what we're getting. And over the next month or so, we're going to see this volatility really precipitously come out. Well, volatility comes out and I've sold options. That means those prices start coming off a little bit. And even if I'm directionally wrong, when you're selling options and that volatility comes out, we talk about in these videos how that affects your pricing incrementally. And that's what I expect to happen with this trade here. We'll settle down here right around 63-ish. So I went in, looked at these Fibonacci's, the 65, 60 strangle in there is what I sold in the December. So I'm looking to capture that month that, I forgot to show a chart, but here, we'll get on with this here real quick. With that said, what I'm talking about here is the going into the D's, further duration, but right in that wheelhouse with theta decay. It's about 35 days to expiration. I drilled down on that in these webinars as well. So I went into the December, sold the 65, 60. So the 65 calls, sold those, and the 60 calls. That's what creates that strangle. And I collected $1.30. So my break even is a little bit higher on my calls and a little bit lower on my puts because I'm collecting that credit. All right. So outside of those two Fibonacci's is where my break even is lying. I'm going to be looking to cover this for about 50% of max profit. Know your exit strategy, as we talked about with Mary Ellen in my last interview. Know your exit strategy before you ever enter that trade. That will keep you in this game longer. For the long term, okay? That's what good traders do, is they know their exits before they enter that trade. And that's what I would hope you all start to learn. Separate the emotion from dollar denominated trading. We need to start thinking about it as ticks and with probabilities. And further, what we want to do is get in and out of these trades quickly, especially if we're newer traders. If any of this has helped you, please smash that like button and subscribe down there at the bottom, as you guys will get notifications when we're popping in here. All right, and that's about it for me today. That's all I've got going. I've got a couple of working orders, like I said, with the XLU, which is probably not going to happen. We're seeing XLU start to come off a little bit, and that's about it for today. It's a holiday, so thank you all for, if you were a veteran or if you served for the United States, whether, I don't even care if it's even a on a ship or in a mess hall. Thank you very much for serving. I do really appreciate everything you do. And everybody else, it's going to be a kind of quiet day, so just play the protection game today and look for some opportunities, because I think we'll start seeing some volatility come out pretty soon. All right, that's all I got for you guys. Have a great one. If you can't take that, take it easy. Bye for now.